Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer. I'm Operations Manager for Wickham Financial Group. I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy, and thanks for our listeners jumping on the call. We basically had some really strong economic data that impacted some rate cut expectations or put some real pressure on the market, really push yields up sharply and those equities down. So we saw the S&P 500 off about 2%, the Nasdaq Composite off about 2.3%, the Russell 2000, the small cap area, gave back about 3.5%. So when we look at 11 sectors of the S&P, of the 8, we saw a decline. We saw technology off about 3%, real estate off about 4%. Now the energy sector on the flip side, we did see an increase as the U.S. put some sanctions on Russia. Now in December jobs growth, that was the canary in the coal mine. That was up about 256,000, well above the forecast that was only expected to be about 155,000. We did see the unemployment drop from 4.2% to 4.1%. So that really put some concerns that the Fed's not going to be so aggressive in lowering rates, or maybe not even at all, or possibly maybe just one. So that moved the Fed funds chance of a rate cut to 50% in June, and then with the potential of possibly only one rate cut. And that put some pressure on the small cap area that was down the most, as well as just equities in general pushing yields up. If we look at the U.S. consumer sentiment for January, that did decrease on that long-term inflation expectation. Now, if we go overseas, we looked at China. Inflation remained pretty subdued, but it is having some rising concerns about deflation. Over in Canada, we did see the PM, Justin Trudeau, announce plans to step down. Over in Europe, we did see it initially rally on some U.S. trade reports, but then reversed due to some pretty strong dollar numbers. Eurozone inflation did accelerate in December. Now this week, what is this week about? We're starting earnings. We're going to have some strong economic numbers coming out, like retail sales, CPI numbers, housing starts, PPI numbers, setting the tone for where inflation could be. Also, keep in mind, on the 20th, we're going to have a new administration coming in, so the market is waiting with bated breath to see what effects or what they're going to do within their first days in office, if you might. But earnings is going to be a driver this week. On Wednesday, I think we start out with the big banks. I think JP Morgan, Citigroup, Bank of America, Morgan Stanley. Then we'll get Taiwan Semiconductor, United Healthcare Group. So we got some pretty big earnings starting out this week, and then we'll pick up some steam as we move into the next few weeks as we get deeper into earnings season. Now, internationally, going back to China, we'll look at some stimulus numbers on GDP, retail sales, industrial production numbers. We'll be getting some trade balance numbers in. Europe's pretty quiet, no big numbers coming out of them, but we'll be looking at the UK for some inflation GDP updates from them. Jeremy?
Thank you, Graham. I had a question for you. Now that we got into the new year here, we've had a little volatility from the 50 in a pullback from the 52-week highs of since last year. Do you see the valuations and the volatility continuing right now?
Yeah, I do. I mean, we had a great year. We had 2 back-to-back 20+% return years for the S&P. So I think we got to expect some volatility and a digestion of that return. Maybe we pulled some of the performance in 25 into 24. So a little bit of profit taking, a little bit of repositioning, maybe taking some profits on the ones who have outperformed the most, maybe moving to the sectors and stocks and areas that have underperformed for 24, getting prepared for what might happen in 25. I think also one thing that we need to be mindful of is a 5% pullback or a 10% pullbacks. These happen. You got to be prepared. They're not always comfortable, but you have to know and realize that they're just a part of investing. And I know most of you do if you've been on the call. You've probably been investing for a while. But one thing we do want to remind our listeners, listen, this 10-year yield, right? The market's shifting back and forth. It's very erratic based on this 10-year yield. Listen, the average yield on the 10-year is about 5.2%. And what we marked about 4.7, 4.8, maybe some movement back up to the 5 area. So we might be moving back into some more normality or average for that yield. And we just haven't seen this for a while, and it's uncomfortable. So I think the market's trying to figure out a bit on which direction it's going to go. Also, we get a lot of questions, Jeremy, and our listeners about, valuations. There are really high valuations that probably aren't justifiable. There are some valuations that are probably below average, as well as the ones that I just mentioned that are above. So the market's not all moving in the same direction, right? We got small and mid cap valuations below large caps when they usually trend a little bit closer in the range. We get international valuations less than large cap US, which isn't unnormal, but maybe a little bit outside of the norm. One thing we want to think about is productivity. Each worker, right? Productivity is increased for them. Increased productivity leads to increased profitability. Increased profitability leads to revenue growth. Revenue growth, you could justify maybe some higher earnings per share, these multiples that we see in the market. So I would not be surprised this year going forward is that we just have to realize that we're going to see higher growth, right? Strong economy, strong consumer, strong earnings with that productivity increasing, leading to higher valuations in the market, which might lead to volatility, but that might not all be a bad thing. It just might be a symptom of a healthy economy.
Gotcha. Well, we always appreciate the expertise, Graham. And to our listeners, we do have our first 2025 webinar coming up this Thursday at 12 o'clock. So we send out an email, but check out our social media for that information. And we look forward to seeing you next week.
Take care.